He kōna I purangi tēnei nā te reo irirangi o Aotearoa.
We've all heard Inland Revenue warning that if we're making money on crypto, we probably need to pay tax on it. But what if we're losing money? What does inflation do to savings accounts? Are there any restrictions on who can offer a KiwiSaver fund? That's some of what we're talking about on this week's episode of No Stupid Questions. I'm Susan Edmonds, I'm RNZ's money correspondent, and I'm joined by Question Asker-in-Chief Justin Gregory.
How you doing? I hold no cryptocurrencies at all.
That's a mixed blessing. Let's get into it.
Okie doke, getting into it. Let's start with Lee, who wants to know, if someone was to make a loss trading crypto, how does one write those losses off against other income? What excellent grammar you have, Lee.
This is a good question too. IRD said just recently that it has identified more than 300,000 people who have taken part in crypto transactions worth $36 billion.
Crikey.
So that's a lot of people, a lot of money. It wants people to know they have to pay tax if they've made money. But as Lee indicates, you should also be able to claim a loss against your taxable income and potentially get some tax back. Deloitte crypto expert Ian Fay has become the person I hassle with all my questions about cryptocurrencies. He says you should be filing the loss in the relevant tax year. So if you made a loss in the year to March this year, you'd be doing that in the return that's due by July 7 this year, or next March if you have an accountant who's doing it for you. He says there are rules about how you work out the loss if there are lots of purchases and sales, but it's usually first in and first out, or the weighted average cost. And you can't claim losses on crypto that you're still holding, so that you haven't sold yet. And then as for practically how you do it, if you are currently being automatically assessed by the IRD, so that's not filling in a tax return each year, most PAYE people would be in this situation, you probably will need to request a tax return. And IRD says if your crypto income doesn't fit into business or self-employed income, you need to report the income or loss in the other income box. I'm doing air quotes there, which you can't see. And this sounds like something it would be worth getting advice on, because I married an accountant to avoid this sort of thing, but that's a dramatic solution and not advised.
That's why you married him?
No comment.
Next up, a question from Henry, who says he's teaching a class of high schoolers at the moment and is encouraging them to sign up to the RNZ Money newsletter. Good on you, Henry. Nice work.
Yay!
He says he wants to know what the implications are of higher inflation on long-term savings and investment. Henry says, in particular, he's wondering about the importance of attaining a positive real rate of return and whether this becomes near impossible through traditional savings options. Oh, good question. He says he's unsure whether interest rates historically rise enough to outpace inflation during inflation spikes and whether more sustained inflation could change this dynamic. Again, what a beautifully worded and grammatically correct question there, Henry. Thank you.
Yes, we're on a roll. And this is actually a major problem with long-term savings. You can easily be going backwards in real terms depending on the return you're getting, whether there's an inflation spike or not, really. So, for example, at the moment, a one-year term deposit at the main banks is paying about 3.7%, but inflation's running at 3.1%, so you're not much ahead there, and savings accounts are well under, as we've talked about before. I talked to Westpac Chief Economist Kelly Eckold about this.
Well, it does, depending on what you're invested in. So if you're investing in something at a fixed rate of interest, then usually inflation is bad news because it actually devalues the real value of what you're going to earn. That's why in inflationary environments, people look for different types of assets that are typically better insulated against the increase in inflation. For example, commodities or things like gold. Obviously, real estate as well is another attractive instrument in those sort of environments.
And I trimmed this part of the question, but Henry also raised the point that the impact of inflation would compound in the same way that the returns would over time.
The loss in purchasing power that you got this year will add on to the loss that you get for the next year as well, if your nominal returns are not keeping pace with that.
Kelly also said that if you're in a fixed term deposit that's rolling over, you might see your rate rising if inflation's rising, but sometimes people are fixed for a longer term so they don't get that benefit or the timing's off or all that sort of thing that we talk about with home loan rates as well. And you can really see the impact of inflation if you use a retirement savings calculator. I went on to Sorted's KiwiSaver calculator, which tells me I'm on track to have about $677,000 when I retire, which sounds nice. But if you don't take inflation into account, it's more than $1 million, which sounds even better, but will work out not so good thanks to inflation.
All right, next question is from Jan. Jan says she notices some KiwiSaver providers charge high fees for funds not providing particularly good returns. Good spotting. Now, Jan wants to know, is there a vetting process determining whether a fund is allowed to be part of the KiwiSaver investment options? And if so, what the vetting criteria might be? Ooh, yeah.
Two parts to this question. Yes, some funds with high fees are delivering returns that are pretty mid, as my kids would say, and some that seem pretty good are average when the fees are taken out. So when you're comparing funds, it's a good idea to compare the returns after fees and taxes to get a good idea of what you're getting for your money. Usually a comparison over a longer period of time is a good idea too. As for what they need to do to be included in KiwiSaver, the Financial Markets Authority makes the call on this, but Jeremy Muir, who's a partner at Minter Ellison Rudd Watts, is a specialist in this sort of thing, and I asked him what's involved.
To set up a KiwiSaver scheme, there isn't really any approval to be a KiwiSaver as such. You need to certainly sign up with the scheme, needs to create a relationship with IRD and things, but there's not a government approval for that unless you are a default scheme. A better example, I think the last one that I worked on setting up would have been Sharesies' KiwiSaver scheme. So to do that, Sharesies, to set up a scheme, needed to have a fund manager license, and that's to be the manager of a MIS, a managed investment scheme, whether it's KiwiSaver or not, so some kind of unit trust investment fund. So they had to get that license from the FMA, and there's a detailed application guide which sets out all the requirements for that around both governance, capability, resources, capital, net tangible assets tests, all of that. And then those are backed when you get a license by the conditions on your license. And there are standard conditions that the FMA puts on all licensees. So to be a fund license, to have a retail fund, KiwiSaver or not, the manager needs to have that license and go through that process, at least to get the license up front. And then they also need to appoint a separate license supervisor, which is covenant, public trust, trustees, executors, guardian. Mm-hmm. Then there are some extra rules for KiwiSaver, which are not so much qualifications, but just rules that apply to KiwiSaver schemes under the KiwiSaver Act. So all of the licensing stuff is under the Financial Markets Conduct Act. Then there are rules for KiwiSaver under the KiwiSaver Act. And those are largely set out in Schedule 1, which are generally referred to as the KiwiSaver scheme rules. And that's where there are things like fees must be reasonable. So that doesn't apply, for example, to non-KiwiSaver schemes. And the KiwiSaver Act also has the things in it like only individuals can be members because it's retirement savings for individuals.
Okay, Barry. How you doing, Barry? Barry wants to know, does paying tax on the employer contribution, this is presumably to KiwiSaver, almost make it meaningless?
So just to quickly recap, employees pay 3.5% of their pre-tax income into their KiwiSaver accounts, but they pay it from their after-tax pay. Employers pay employer superannuation contribution tax on their bit, the other 3.5%, which is also calculated on your gross pay, but the tax is then applied before the contribution goes in. So your employer contribution is usually less coming into your KiwiSaver account. But it's not meaningless. Rupert Carlyon at Kora points out that there's no real incentive to having it go in as an employer contribution, though, versus a voluntary contribution that's paid using after-tax income. And whether we need more incentives to save with things like tax incentives is one of those things that's being debated a lot at the moment.
Still on the KiwiSaver topic, Taylor says, I have an aggressive KiwiSaver fund with lots of international shares. It dropped a lot in value after the start of the war, yeah, I bet, but it is now within a hair's breadth of where it was prior to the war. Oh, good one. Can you please explain the recovery? Good question. As far as I can tell, there is no confidence of a return to normal anytime soon, says Taylor. So what optimism is there that enables my KiwiSaver to recover? This is a mystery to me, says Taylor, and also to me, says Justin. Susan, what do you got?
Yeah, and also to me. It's quite surprising how strong markets have been. Some of them are still at or near records despite the craziness going on in the world. Yeah. I actually looked at this recently and people told me there are a few things that we can give credit to here. The US economy is quite strong at the moment and probably actually stronger than expected. And some tech companies are back in favour, which has helped because they are a large part of lots of these markets. There's quite a bit of excitement about AI again, and the US is going through a pretty good earnings season. Yes, we are a notable underperformer. We're at best flat. So, yeah, not top of the world on this one.
Now, speaking of AI, you had a story recently, Susan, about the Tenancy Tribunal getting a lot of applications that are very obviously being written with the help of AI. What's the standout qualities there?
Yeah, property managers tell me it's not uncommon for these to run to hundreds of pages and for people sometimes to have been told by AI that they should be asking for tens of thousands of dollars in compensation, that sort of thing. And unfortunately, the tribunal doesn't always agree.
Well, colour me surprised.
Yeah. The other concern is that it could be slowing down the process because we know the tribunal isn't always the speediest of institutions and it does have a bit of a backlog.
Okay, I mean, asking for many, many thousands of dollars may or may not be realistic, and hundreds of pages is probably not going to get you to the top of the pile. But it's a good thing that people are getting some help, though, isn't it?
I think it probably is overall because I think there is sometimes a bit of a power imbalance there for tenants that are going to the tribunal. But I think it's probably the case that it will also calm down as people get more used to AI and know how to spot hallucinations and that sort of thing. I imagine it's not great to be told that you've got a case to ask for $40,000 and then have the tribunal tell you that you can have $80, which happened in one situation. But we should remember that the bulk of the applications to the tribunal are from landlords for rent arrears. So maybe if there was a better way to deal with that, that would be a better solution.
Last week, we asked you what was the best performer on the New Zealand Stock Exchange in 2025? And the answer is?
The answer is Sanford, which was up 75%. Yeah, A2 Milk also had a good run, which was overdue. I say that as someone who bought shares just before the peak.
Time in the market, Susan, not time in the market. Yeah.
Yes.
Now, this week, we're asking how long ago it was that New Zealand women weren't able to take a mortgage on their own, and sideline, how soon it will happen again in the United States.
That's grim. Send your answers as well as any memories you want to share or hopes for the future to questions@rnz.co.nz. No Stupid Questions with Susan Edmonds was written and presented by Susan Edmonds. That's me. Justin Gregory is the producer. The engineer is Phil Benge. Thanks to Lee, Henry, Frank, Jan, Barry and Taylor for their questions, and Ian Fay, Kelly Eckold, Jeremy Muir and Rupert Carline for their answers. Follow and listen to No Stupid Questions with Susan Edmonds on Apple Podcasts, Spotify or any podcast app so you don't miss an episode. Stay safe, everyone.